In our testing, confluence signals have significantly higher hit rates because when all three flows align, when the pipeline says buy, the geopolitical flow confirms the macro setup, and the portfolio says your current positions are safe, that's a high conviction moment. All three of those signal flows, the pipeline, the geopolitical, and the portfolio, they all converge on the same destination, the trading desk. I have 6 AI trading agents. Each one has a completely different investment philosophy, risk tolerance, and decision-making framework. And as of yesterday, each one is managing a $100,000 portfolio. Real paper trading accounts, real entries and exits automatically. All three signal flows, pipeline, geopolitical, and portfolio, feed directly into these agents, and they independently decide when to enter positions and when to exit. No manual intervention. Think of them as 6 portfolio managers sitting around a table and all looking at the same data, but seeing completely different things, and each making their own trades. We've got the technician. Charts are his Bible. He looks at patterns, regime changes, and mean reversion. If the technical setup doesn't support a trade, he won't touch it. He doesn't care what the fundamentals say, just show him the chart. Now we have the Oracle, the classic value investor. He's looking for intrinsic value. He wants to buy great assets at a fair price and hold them. He's the one who will ignore a buy signal on a speculative crypto position because it just doesn't meet his quality criteria. Patience is his superpower. The contrarian, hard money advocate, gold, commodities, inflation hedges. If the macro environment suggests currency debasement or inflationary pressure, this is your guy. He's also the most skeptical of tech-heavy positions. When everyone else is piling into growth, he's buying gold. The macro man. Global liquidity is his North Star. He thinks in terms of liquidity cycles, the dollar, crypto as a macro asset. When the liquidity tide is rising, he gets aggressive. When it's receding, he gets defensive. He sees the whole chessboard. The scout. Growth at a reasonable price. That's his mantra. He's looking for asymmetric opportunities, assets that are undervalued relative to their growth potential. He'll buy what the Oracle won't, but only if the risk-reward ratio works. The architect. Diversification is his religion. He's building a portfolio designed to survive at any regime. Inflation, deflation, rising growth, falling growth. While everyone else is chasing momentum, he's rebalancing. Boring? Maybe. Resilient? Absolutely. All three signal flows produce their own output. Those signals get fed into all 6 of these agents simultaneously, and each agent independently decides, based on their unique philosophy, whether to act. The technician might see a buy signal on the QQQ and say, yes, this setup is perfect. The Oracle might see the same signal and say, no, it's overvalued. The contrarian ignores it entirely because he's allocated to gold.